Greetings, my friends, and happy Tuesday to you. On our last podcast, we introduced part two of our sixth step of our 7 Money Milestones series, which was Build Your Wealth. And if you recall, the key to building your wealth is to ensure that it lasts as long as you do. However, we also discussed and identified that there were 3 of 4 threats that every wealth builder must conquer. They were procrastination, inflation, and loss. Today, I will discuss part 3 of our sixth step of our 7 Money Milestone series, where we will cover in more detail the 4th threat that every wealth builder must conquer. And that threat is taxes. Now, just like last week, now that you are aware that taxes are a threat, it's time to review strategies that can help you conquer them. Again, another critical step on your roadmap to financial security and independence. So, if you're ready, let's talk Tuesday. Now, you pay taxes to federal and state governments on your salary, wages, and income on an annual basis. Today's segment is not about that, though. We will focus on how earnings from various savings and investment vehicles are taxed. And when you know how these taxes work, you're better equipped to make decisions with your financial professional about which strategies are most advantageous for you. Now, there are 3 different ways that savings and investment accounts are taxed. Tax now, tax later, or tax deferred, or tax never, or tax free. So let's take tax now. With accounts of this type, you pay taxes on interest, earnings, and dividends every single year. Examples would be including stocks and bonds, mutual funds, savings accounts, and certificate of deposits. Some people refer to those as CDs. Under tax later or tax deferred, those accounts, you are not taxed until you start taking distributions in retirement. Examples would include traditional IRAs, 401ks and 403bs, and annuities. And tax never or tax free. With these type of accounts, your earnings and distributions are never taxed. Examples of those type of accounts would include Roth IRAs, permanent life insurance, municipal bonds, and college savings plans. Now, there's a concept out there that I think you need to be aware of. It's called the seed versus the harvest. And the reason why you need to be aware of it is because it's going to be a big question that you need to answer when it comes to paying taxes. Consider this example. If you save $10,000 at age 29 and earn a 9% annual return on your interest each year, you will have about $250,000 at age 65. So the question is, would you rather pay taxes on the seed? The seed being paying tax on the initial $10,000, meaning that you will be paying on the principal and not your earnings, and you will be paying at today's tax rate? Or would you rather pay tax on the $250,000 harvest, meaning all of your earnings will be taxed, and you will pay the future tax rate, which could be higher? Something to ponder. Now, for the next few minutes, let's explore how taxes affects various savings and investment accounts. With taxable accounts, You make an investment with money that already has been taxed. For example, the income you've earned from your business or your salary and wages from employment. With those accounts, you pay taxes annually on the interest and dividends in your accounts earned, unless it's held in a qualified retirement plan. Now, speaking of qualified retirement plans, those are 401ks, 403bs, 457s, and IRA plans. Your pre-tax dollars grow without having to pay taxes on the principal or growth until retirement, at which you will pay income tax at the future tax rate on the full amount of distributions each year. And then you have annuities. Monies invested in an annuity, except for qualified retirement plans, will have already been taxed. The growth in an annuity is tax deferred until retirement. At that time, you'll pay income tax on the growth portion of your distributions each year. Government bonds. You use after-tax money to invest in government and municipal bonds, excluding qualified retirement plans. The interest on federal government bonds is taxable at the federal level, but not at the state and local level. Conversely, the interest on municipal bonds is exempt from federal income tax. And if you live in a state in which the municipal is issued, you can also avoid state and local taxes as well. Roth IRAs. You invest in a Roth IRA with after-tax dollars. Your accounts grows tax-free, and you don't pay taxes on distributions in retirement. Unfortunately, though, the IRS limits the use of Roth IRAs to people below a specific income level and restricts the annual amount they can add to their accounts each year. And then there is my favorite product because of its flexibility, and that is permanent life insurance. Premiums are paid with after-tax dollars, so as long as your policy remains active, you will never pay taxes on distributions you take for supplemental retirement income or specific purchases. Distributions, however, will reduce your death benefit, and the IRS does not limit the annual amount you can contribute or restrict income levels for eligibility. So, here we are. The big question: how to avoid the risk of running out of money in retirement. You want to have a guaranteed income. In a recent Gallup survey, 85% of non-retired American investors strongly agreed that having a guaranteed income stream in retirement to supplement Social Security benefits is critical. So let's talk about it. Company pensions are all but obsolete. Employees now rely on a combination of 401k plans and Social Security benefits to provide enough money to live in retirement. The average 60 to 69-year-old American only has about $196,000 in their 401k. The average income of 65-year-olds is around $48,700. That is almost 1/4 of their 401k balance. So, how many years will their 401k last? So let's say you're living on only about 50% of the $48,700 income you had before retiring. And that's about $24,400. Now, I'm sort of rounding up a little bit just to make the math a little easier to follow. But if you factor in 2.8% inflation that we discussed, and annually, I should add, and you could get a 6% annual return on your 401k account, which is about $195,500, you will run out of money in approximately 9 years. That means if you started taking distributions at age 67 from your 401k, it would all be gone by the time you were age 76. Now, what if you lived until you were 85 or 95? Will Social Security be enough? In the previous podcast, we discussed the behaviors of building wealth, and you are aware of the threats that we discussed today. But by making your wealth last as long as you do can seem like a bigger challenge than building it. This is especially true with retirement now lasting 2 or 3 decades, or in some cases, even longer. So how do you begin? Start by working with your financial professional to calculate your probability of running out of money based on your current financial trajectory. Then you can explore options to establish a reliable monthly retirement income you can depend on while you still have time to do something about it. If you don't have a financial advisor, or if you're in need of a financial coach to help you develop a game plan or a winning strategy to build wealth, give us a call to schedule a free consultation today at 937-889-9809, or email us at the Academy of Financial Literacy at gmail.com. Finally, our ministry is changing lives. It's made a big difference for many clients as we provide the highest level of excellence. I want to thank you for partnering with us to stomp out illiteracy while creating financial independence in our community. Bless you for blessing us with your gift at the link below. And join us for our next podcast, where we will introduce the 7th step of our 7 Money Milestones series: how to protect your wealth, your roadmap to financial security and independence. You don't want to miss it. Until next time, let's talk Tuesday.